All right, we'll go ahead and get started. So thank you for joining. So I'm Mark Lamonica. I look after the individual investor team for Morningstar in Australia. Today we're going to talk about 3 blue chip growth shares. So I picked a couple that I thought people would find interesting, but we'll get to that in a second. First, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you are over in New Zealand, you get a copy of our FAP on our website, morningstar.com.au. And also, the New Zealand regulatory authorities would encourage you to talk to a financial advisor if you would like personal advice. So, as I said, 3 growth shares. We'll get to those names in a second. We can do like a drum roll, maybe something you could do. Emily, on the table. I don't know. I know she's looking at me like I'm crazy. But first, yeah, you can listen to our podcast. We're publishing our 100th episode on Sunday, which hopefully will be a good one. Follow us on Instagram and come to our conference. So we've actually announced the agenda. It is a really good agenda from my perspective. We are going to talk about investing and not investments. So a lot of conferences that I go to are just like product pitches, right? So an investment manager, a fund manager gets up there and just talks up their own product. But we're doing things a little differently. So we're going to focus on how to set up goals, asset allocation. We have a lot of different experts coming in to talk about asset allocation. We're going to talk about selecting investments. And then, of course, we're going to talk about investing during times like this or investing right now. So I think it should be interesting. We've gone more of the kind of CIO route rather than like a fund manager so that we can get that asset allocation perspective because that's so important to investors. So join the wait list, send me an email if you would like a ticket. All right. This is where we're going to have the drum roll. But the drum roll, we missed out our opportunity for the drum roll. So I picked 3 companies. I'll show you how I picked them in a second, but I want to do stuff that I thought would be interesting to an Aussie audience. So I picked Wisetech, which obviously we'll get into, picked Atlassian, so an Aussie company, but trades over in New York on the Nasdaq, and I picked Adobe. There's some similarities around these companies, but I thought that would be a good point of comparison. But first, how did I come up with my list? Well, part of it is I just came, Will says, what no alcohol companies? No, I see some alcohol in my future, but today we're talking about growth shares, Will. So Will is all excited because Will is going on vacation tomorrow. He is off to Singapore, so he's in a very chipper mood. Will, of course, is our videographer for anyone new. All right, so how did I find these 3 companies? So Emily, who came up with the topic today, said blue chip growth companies that are trading for less than we think they're worth. So I used our filter. So very simply, we've got 49,436 companies in our database. That's a lot. So what I did is I looked at large growth companies. I looked at, from a valuation perspective, 4 and 5 stars stocks. And we'll talk a little bit about this. So that, of course, corresponds to what our analysts think the share is worth. And then, of course, what it is trading for. And then we had that blue chip. So the 2 things I did in blue chip, one, I did large cap, so larger companies. And blue chip, there is really no definition. So I'm allowed to do what I want. And then quality, I put a wide or narrow moat. So that's sort of my definition of a blue chip. We're going to look at large companies that have moats or sustainable competitive advantages. And 61 results came up. And basically, I just went through and tried to find things that are interesting, that I thought were interesting for Aussie investors. So we are going to go through these 3 different companies. And what I thought I'd do is kind of take you through our research reports on them, because I thought that would be a good opportunity to talk about the different things our analysts look at, and different things that we can consider as investors. All right. So why don't we start with Wisetech? Kind of before we get into Wisetech, all 3 of these companies are similar because they all are software as a service company. So something maybe people have heard. Now, why do people, first of all, what is a software as a service company? It is basically, at the end of the day, software that is purchased using a subscription. So a subscription service to software. So the software, of course, is generally hosted on the cloud. And this differs from the way that software used to be purchased. Or people that remember that is you would go to a store and you would buy a CD, and the CD would have the software on it. So maybe you would go buy Microsoft Windows and you take that and you put it into your computer. And obviously there's a lot of inefficiencies with this. But the other problem, of course, for companies, with any company, one of the most difficult things to do, of course, is to sell things. And that's the whole point of a company. And that's why companies really like subscription services, because you're not out there selling, trying to fight to sell every single unit. That you have these subscription services. The subscription services, and we'll talk about Moat in a second, allow you to embed yourself within the company. And generally, there are high switching costs, which we'll talk about more of, so that people just continue to renew those subscriptions. The other nice thing is you get the money up front, right? So that's a nice thing as well. You get the money at the beginning of the subscription generally, and then of course you have time to deliver it. So what does this provide to companies, or what do investors like about it? It is a pretty stable, recurring revenue model. All of that is great, and it's very easy to cross-sell things, right? Once you're in a company and established in a company, like software often becomes, it's great to retain customers. It's great to cross-sell new features that you have. And it's great, of course, to have that recurring revenue. All right. So let's talk about Wisetech. So Wisetech is one of the homegrown Aussie software companies. Louise subscribes to Adobe, and they've just increased their prices. So yeah, we'll get to your question in a second, Bernie. Let's talk about a couple of these companies for a second. All right, so Wisetech is one of the homegrown Australian success stories in technology. And what Wisetech basically does is it creates software that helps out logistics companies, so global logistics companies that are moving things around the world, which of course is supporting global trade and all the different things we love, foreign products, selling things to other countries. That's what Wisetech does. And so it's basically logistic software. So when you're looking at a company, the first thing that I like to do, and how I'd encourage you to look at companies, is number one, think about whether this is something that's right for you, what kind of investments that you actually like. So a couple things that I mentioned here, which we'll get into in details. All three of these are growth companies. So growth and value companies, really all they are at the end of the day, and we'll talk about why people think what they want about it, why people think what they do about these companies, and it does make sense, but all we're doing is we're splitting up the universe of shares into valuation boxes. So if you look at Morningstar, generally what you have, and if we go back to these filters, is you have value, core, and growth. So the most expensive companies from a valuation perspective go into growth. Cheapest companies go into value. Now, when we're talking about this, we are referring to relative valuation measures, and it's often a mixture that you use. We are not talking about the way we and other analysts value companies, and that is creating a discounted cash flow model. So remember, very different things. So a relative valuation measure is something like a price to earnings ratio or a price to book ratio, where we're looking at the price of the share versus, in an earnings case, how much they earn. So we're taking these relative valuation measures, we're ranking all of the companies. There is no reason why a company has to stay in one of these boxes, right? An expensive company could become cheap if those valuation levels change. Could move from growth into value. Same thing with the value company. People could decide they want to pay more for it. It could move from value to growth. But generally what we're paying for and why we're paying a higher multiple for growth companies, why we're paying a higher valuation level, is because they are supposed to earn more in the future. They're supposed to grow faster, because that's what we care about as investors, right? Like as investors, we care about the future. If a company is going to grow faster in the future, we would pay more for that. The risk, of course, with investing in a growth company is, what if this very rosy scenario does not happen? So we'll talk about this as we go through each one of these companies, but I want to set that context. The other things, of course, you can look at when you're just looking at a company is just a quick scan to see sort of what your investment strategy is, and is this something that you should invest in. So I actually went through and screened this, but you can look at the investment style. All right, so large growth. So this is a big company, right? Based on market capitalization. There are differences between big companies and small companies. Big companies are generally better established. They have more customers. They generally serve global markets instead of maybe very local markets. They're generally in better financial situation, have more access to capital. Generally, big companies are less volatile than lower companies. We can look at sectors. Sectors matter. The reason sectors matter is because different sectors will perform differently during different parts of the economic cycle. So there are some sectors that are more cyclical, meaning that they will, of course, their fortunes will improve when the economy is doing well, and maybe not do so well as the economy is doing poorly. I think Wisetech gets classified in that. Some sectors, like if we were looking at an alcohol company, like Will's little joke about my one-track mind, we were looking at an alcohol company, people generally drink if the economy is going well or the economy is doing poorly. Now you can make a joke about people drink more when the economy is doing poorly. So those companies, and that's consumer defensive, are companies that are going to kind of just keep doing okay regardless of the economic cycle. So once again, a company that is more cyclical should be more volatile over an entire market cycle versus a company that is not cyclical. The other thing that I always look at, and that is important to look at, of course, is dividends, because some investors very much like dividends. I am one of them. So you can quickly go and see, okay, does this company pay a dividend? And if so, how much? So if we look at Wisetech, all right, the dividend's grown in 2021. That's a good thing. But they're paying basically nothing, right? So the dividend yield on Wisetech is nothing. So 0.11, so not a lot. So something to consider as well. So companies generally that pay dividends are, once again, less volatile than companies that don't, because of all the things that dividend signals, right? A dividend signals that a company, number one, is generating cash flows or earning money so they can give it back to shareholders. Could indicate that they're more financially stable. Could indicate that they're more established. They've gotten out of that startup phase where they're just trying to invest all of that cash into growth. So dividends, whether you like them or not, could make a company less volatile, at least in the aggregate. All right, let's go into our analyst report. So Gareth is our analyst here in Sydney that covers Wisetech. So how do you read an analyst report? Well, a couple things to scan quickly. So number one, fair value. And we'll talk about how Gareth comes up with the fair value, but the fair value, of course, is what Gareth believes this company is worth. We compare that to the price. Well, sorry, that's twice in a row I've yawned. It's an issue. So if we compare that to the price, we can see it's trading at an 18% discount, which corresponds to that 4-star stock. All right. Does it have an economic moat? We'll cover why in a second. Yes, it does. All right. Capital allocation. Again, we'll talk about this as we go through the report. Capital allocation refers to what decisions does a company make with the money they have. So with either decisions they make around borrowing money, decisions they make of what to do with the cash flows they generate. Are they making good decisions or poor decisions? And capital allocation, of course, is kind of the number one job of a CEO, right? What am I going to do with the cash that my company generates? Am I going to give it back to shareholders? Am I going to invest in growth? Am I going to empire build and get a bunch of private planes and go try to buy other companies? How do those acquisitions go? All things that will contribute to capital allocation. And then the last thing we want to look at is the uncertainty rating. And we'll talk more about this, but uncertainty high, that means how confident is Gareth in his projections out into the future? And there are different things. This isn't like, a Gareth self-esteem thing. How confident is he? But there are different things that will make analysts more or less confident in their ability to predict the future. All right. So I'm obviously not going to read this line by line. A couple of things that jump out to me. So the business strategy and outlook. Gareth is obviously talking about business strategy and outlook. So what is their strategy for success, and how does he think that that's going to play out? And I think the big thing right here is that we talked about growth. And, here is growth, right? So basically Gareth is saying the past 7 years, revenue grew. So the amount of sales they had at 34% compounded annual growth rate. And he thinks he'll grow 19% over the next decade. So that is very good. So something that obviously should resonate with you is, all right, this company needs to continue to grow, and we'll find out why, because it's justifying a really high valuation, but those are pretty high growth numbers, although they're slowing. And then what he looks at is what does the revenue growth translate into? Because what we care about as companies, how much does a company sell? And then how much do they get to keep? What does that translate into? Oh, good. I keep yawning, Emily. Earnings per share growing at 22% over the decade. All right. So that's really important to look at. And it's also really important, especially with companies that are growth companies. How do they maintain that growth? Well, they need a big enough market to actually grow into. Right. And this is where, when we're analyzing businesses, we want to look at what is that pie out there that they are trying to go get a piece of. Obviously, the bigger that it is, the better their opportunity is for a company to grow. So Gareth is saying Wisetech only fulfills 5% of global logistics software, right? So what that means is that if they can successfully compete against competitors, and in this case, in-house created software, if they can successfully compete against that, there is a very large total addressable market for them to go out there and look at. All right, so let's quickly keep going. Economic moat. So once again, an economic moat refers to a sustainable competitive advantage. So why do we like this as investors? Well, we like this, of course, because it means that all the things that all the impacts that competition has on companies are not going to impact them. So basically competing away that margin and the return on invested capital. So Gareth believes that Wisetech has a narrow economic moat based on switching costs. And he's provided some evidence, 99% customer retention rate over the past 4 years. So that's pretty good. Hard to get much better than that. So what does switching costs mean? Well, for every moat that our analysts assign to a company, they will also look at the moat source. We have 5 different moat sources at Morningstar. And as I said, software as a service typically aligns to switching costs. And what that means is that people don't switch because it's a pain to do it. Right. And that's what companies are trying to do with this software as a service. They're trying to embed themselves within a company so that the company does not want to switch. It becomes core to everything that they do. And we'll talk about this with each one of these companies today that we're going to cover, because all of them have moats. All of their moats have one of the moat sources being switching costs. All right, so you can read obviously why Gareth thinks that, and certainly evidenced by this 99% customer retention. The other really important thing that Gareth points out here that's important about moats is it is not just retaining customers, but it's also pricing power. And that was the comment that Louise had, right? And we'll talk about that with Adobe, that you want to, number one, embed yourself within a company, but you also want to be able to raise prices over time, right? Especially at a time like this when we have inflation. So pricing power is really important. And he does talk about this in the report, how basically they win out over cheaper providers because their capabilities are better. Gareth talks about at the end of this how there is potentially another moat source, and that moat source that might be building over time is network effect. And basically, obviously, with logistics software, a lot of what you're entering into this is, of course, what good are you shipping, how, where, and managing whatever that entire workflow is, whether it starts on a truck or a train, then goes on a boat or a plane, gets on another truck or train, right? All of these things that we are contending with to ship things around the world to kind of support the lifestyle that many people have. So he's saying that this is emerging, but network effect is not there yet. What network effect refers to, that's another moat source, is it just refers to the source, it refers to a product that becomes more valuable the more people use it. So many times, of course, if you are a logistics company, you're dealing with other logistics companies, right? So, you know, in that example, again, maybe you're dealing with a railway to try to get something shipped on a train to a port. Then you're dealing with like a shipping company. And so all of these things need to talk to each other. So what Gareth is saying is that once something is entered into its platform, once the data on whatever is being shipped is entered into its platform, Wisetech helps customers at all these different stages of the supply chain. So basically what it does is it all talks to each other. It's easier if it's in one system. All right, fair value and profit drivers. So Gareth is estimating what this company is worth, and we estimate what every company we cover is worth. So that is creating a discounted cash flow model. So what you're doing is you're estimating out future cash flows, then you're discounting them back to the present day. So we won't spend too much time on that, but that is how you value a company. Now let's think about this. We have a growth company that's growing very quickly. So a lot of the value here is far into the future. So he says his estimate is $65 per share. That implies a fiscal 2022 price to earnings ratio of 131. That is huge. So 131 is obviously very high. So why would you pay that much for a company? You have to believe it's going to grow very quickly and bring that multiple down in the future. So yeah, pretty high. So everything that we're going to look at is going to be around, okay, can this company grow that much? Can they make money off of that? And Gareth thinks yes. So what does he say? Two things. He assumes revenue growth is very fast. He says they have a scalable business model, which means EBIT margin expansion from 31% to 40% by fiscal 2031. Okay, so let's explain that, because that is a very confusing sentence for a lot of people. All right, first of all, let's talk about software and software as a service. So we've said a lot on here, I've said a lot on here, that software is very scalable. It's why investors like technology companies. And what that means is that Wisetech, we'll use them as an example, they have some developers, some engineers creating this software, and they have 5% of the market. If they were to expand to 50% of the market, they probably don't really need to hire anybody else to develop the software, right? It's immensely scalable. I can give the same software to Emily or anyone else, right? So I just have to create something once. It's very different than if I'm a car manufacturer, because I can build a car and sell it to Emily, but I can't sell Emily's car to anyone else. So it means that if I want to make more profit, I have to build another car, right? That's hard. Software is easy because I do stuff once. I give it to lots of people. Now, of course, software companies, like any company, as they grow sales and as they get larger, they do have to hire more people, but nowhere to the extent that you would in sort of a non-scalable business, right? Where if I'm a business where for every customer I get, I need to support them with a new person. Not one-to-one would be pretty bad, but every allotment of companies, I need to go in and hire a bunch of new people to service those clients. Well, okay, that makes it less scalable. It's even less scalable if I'm a company that has to build a factory. If I happen to sell a lot of goods, I have to build a factory. So what is he saying here? He's saying it's scalable. They've got a scalable business model. He's looking at EBIT margin expansion. So earnings before interest and taxes. So what does that mean? It means basically he is forgetting interest payments that they have on debt. He's forgetting taxes. Both of those could grow, right? Like companies need capital to expand, even if you're a software company, right? So they could be borrowing some money. Their taxes will go up as they make more money. But what he's saying is because they're so scalable and because he thinks revenue growth is going to be so high, that means that their margin's going to expand. The amount of money they keep based on what they sell, 31% to 40%. That's where we're getting those kickers on earnings, right? We really like these scalable companies that are growing revenue as investors because a lot of the new revenue they make flows down to the bottom line, right? So once again, same amount of software development effort to sell the first product as the 1 millionth. That's why we like technology companies, growing revenue, growing margin, both very, very good things. When he does talk about costs, a lot of the costs are in research and development. Why? Because you have to continually update your software. So we want to sell it to a larger base, but we still need to spend money to make sure that it is cutting edge software. All right. So that is what goes into, and you can read all the different inputs when he's estimating out these future cash flows, right? Revenue grows at this, margin expands, here are the costs. He's basically building out this model to project out those cash flows in the future. He's giving us some of those inputs into it. All right. Other things that are important. So balance sheet. So in this case, they have no debt. Now, why do they have no debt? They most likely have no debt because it's been pretty easy environment to go out there and raise capital in the past couple of years, particularly if you're a technology company, right? So you raise capital by selling equity. So that's what they've been doing. Weighted average cost of capital, 7.5%. So why does this matter? Well, it matters, of course, because as companies, what we want to do is we want to raise capital at a certain amount, invest it, and earn a higher return than it costs us to get that capital. So this is low. All right. Got some questions piling up. All right. I will get to these. I'll get to these questions in 1 second. Let me just finish this one up. I'll get to them before moving on. So risk and uncertainty. Our analysts and any investor is predicting the future, right? You are buying something, you are buying a share, or you're buying a collection of shares in an ETF because you are predicting the future, because that's all that matters to us as investors. Past informs what we think might happen in the future, but it doesn't matter. So we're always forward looking. As I said before, some companies, it's a lot harder to predict the future than others, right? The example I always use is Coca-Cola. It's pretty easy to predict the future with Coke. They're going to sell Coke. It's not going to decrease significantly. It's not going to increase significantly. Like, a lot easier to predict the future. So why does Wisetech have such a high risk rating? So remember, if we go back up here, uncertainty, high. So it says it right there. So why is his uncertainty so high? All right, well, let's read what he says. Okay, fair value estimate is based on relatively high earnings growth rates over the next decade. So it is harder to grow fast than it is to grow slow. Should be obvious. So small changes in assumptions can have large impacts on these growth rates and our fair value estimates. So why? Why does that happen? Because with growth companies, more of the value of a growth company is further out in the future. So a couple different things happen with growth companies. Number one, yes, when things happen to a growth company, if sales fall short and analysts then predict that sales in the future will be less, or when interest rates go up, you can see larger valuation hits. And the reason for that is because of these high growth rates, right? If I have very very low growth rates, small changes in those don't matter as much. So I'm supposed to move 2% a year. But with very high growth rates, if I miss earnings, for an example, and then that miss is basically amplified by 38% the next year, 38% the next year, because we're seeing all this growth, can be a bigger factor because those cash flows are further out in the future and we discount them back to the present day. If that discount rate or interest rates are higher, it's going to have a bigger impact on the valuation. So that's what he is saying. The other thing he's saying, of course, like any business, if companies' research and development activities are unsuccessful, they can lose market share. So basically what it means is they need to go out there and continue to produce market-leading software in order to grow as fast as they think they are, maintain their current customers, and capture a bigger part of this big pie. Finally, he's talking about the CEO. Many younger companies, of course, were founded by a CEO who generally is fairly charismatic and maybe came up with the idea in the first place. Well, that's the case for Wisetech with Richard White. They're basically saying that the company is very dependent on him. That increases key man risk. So key man risk increases the uncertainty of what's going to happen in the future. Where some companies, the CEO leaves and, hey, maybe it'd be better, but doesn't really matter, right? It's a Warren Buffett quote is like, you want to invest in companies that an idiot could run because one day they will. So if you're investing in one of those companies, you're less worried about this key man risk or key person risk, to be more politically correct. Finally, capital allocation. So you can read what he says. He's pretty pleased with the way that they're allocating capital. This is our highest level exemplary. So this is what we're talking about. The company Wisetech does not require material fixed asset investment to operate a software as a service business model. So what does that mean? It means that fixed asset investment is building a factory, for example. That could be fixed asset investment. They don't need to do that because of the business model that they're in. All right, so that's Wisetech. Let's answer a couple questions. Okay, so Jess says, what is Kager? So Kager stands for compounded annual growth rate. So if you want to calculate Kager, of course you can do it yourself, but just Google Kager calculator. So all that's saying is that if I know what something is, we can just do it. We'll do it live. How about that? Way nothing sketchy comes up on my computer that I've been searching for. So Kager calculator. All right, if we want to calculate the growth rate very simply, and we know what the starting value. So let's say this thing was 100 and it was 200. And I don't have any particular reason why I use this calculator. There's a lot of them over 5 years. This thing is going to calculate the compound annual growth rate. So that's what that figure is that Gareth is giving you. All right, it's a good question. All right, I've got a question from Bernie. The Nasdaq is bullish again. Have all negatives been factored in, or are there further headwinds? Well, Bernie, first of all, I'd say, obviously, I can't predict the future, but we can talk kind of about what's happened. So market went up pretty significantly last night. Market did very well in July, both Australia, US, global markets. What happened overnight is basically inflation in the US. The reading came in slightly below what analysts predicted. So everyone's been really excited about that. So kind of what's happening, the shift that has happened is that, remember, markets are always looking forward. So while the US inflation number was still horrible in any sort of historic sense, they were predicting forward, and now they're predicting what that means in the future. And what a lot of investors started thinking in July, from sort of the doom and gloom era, which was like a month before, a lot of investors started thinking, okay, rates will have to stop going up, and potentially they will be cut last year or next year. So if central banks are throwing economies into a recession to combat inflation, then potentially, and they do that, and that works, and inflation comes down, then potentially next year we could have reductions in rate to try to stimulate the economy again. So this is kind of what, in general, the market is thinking. And as I said before, growth shares are affected by interest rates more than value shares because the value so far in the future, and it's the discount rate. The Nasdaq is full of growth shares, and the Nasdaq is an exchange that has a lot of technology shares on it. So that is why the Nasdaq is doing so well. Now, I don't know what's going to happen in the future. So this is a pretty rosy scenario, which does not make it implausible, but are we going to get to a stage where inflation is brought under control, even if it wrecks the economy, and then that causes further rate hikes or rate reductions next year? I don't know. I have no way of predicting that, but that's sort of the mindset of the market right now, where 2 months ago, the mindset of the market is we're all screwed. Inflation's out of control. There's a war. Like, I don't know. That's just the mindset of the market right now. And so it's just all based on future expectations. And we have no idea. You can take an alternate view and sit there and say that inflation's still really high. Things are going on with Taiwan and China. So geopolitically, there's issues. Any sort of economic sanctions against China or any trade embargo of Taiwan would be disastrous. Like, I don't know. There's different ways to read things. So when the market seems to be in a pretty positive mood right now. All right, we've got a good question. Have noted that Morningstar Quant Value shows Wisetech at $56.76 when it's seen on premium. It is different. Why the difference? The difference is that our quant value is not done by analysts. So Gareth, who sits over there from the UK, been in Australia forever, nice guy. He's coming up with this fair value. Some Morningstar computer is coming up with the quant value. So we sell our quant research to a lot of brokerage firms. You'll see that in your broker. It's just different from what our analyst is doing. So the reason that it's different is because in one sense, a computer is trying to come up with that. In another sense, Gareth is sitting at a desk over there trying to do that. So that is the difference. So Belinda says, Mark, I usually check the size of the company by checking the market capitalization. What is the market capitalization of large and medium companies? Okay, so the issue, Belinda, with market capitalization is it varies by market. For instance, and I have not checked this in a while, so this could have changed. There's a time period earlier in this year where Apple, just that one company, had a larger market capitalization than every share that traded in Australia. So Apple was a larger company than every company in Australia. When we talk about large, we're just looking at number of shares outstanding times the price of the shares. So naturally, the US would have different definitions of what is large, small, and medium, because we're ranking them. Once again, we're ranking them within the market. So there's no clear definition. So what we do with those boxes, where it said large growth for Wisetech, is we're looking at the market and where this company fits within the market. So sorry, that's not a great answer, perhaps. But yeah, that's market capitalization. So what you can do is you can go look at these and we'll compare them because these are all large growth companies, remember. So as we move on to our next one, we can compare these. So basically, when we go on to this quote page, which is where we saw that large growth indicator, so that's where you can go see where a company falls on that spectrum. It will also have the market cap. So $17 billion. So that is a big company in Australia. It is not a big company in other places. So if we go to Atlassian, so Atlassian is an Aussie company. So Mike Cannon-Brookes, who's in the paper all the time around AGL and environmental causes, he's the billionaire founder of Atlassian. We hear about him a lot. So now, in this case, even though it's an Aussie company started by an Aussie, it's actually trading in New York. So it is not trading on the ASX. So we can go check out Atlassian and see where it fits on that spectrum. All right, it is also large growth, but it is $72 billion market cap. So much bigger than Wisetech. Meaning, of course, if Wisetech was sitting in the US markets, it would not be a large growth. I don't know exactly where it'd be, but it'd either be a mid cap or potentially, probably be a mid cap. To be fair, but yeah, that's where it would sit on that style box. Okay, so once again, let's do our little check. Do they pay a dividend? So we saw the market cap. Once again, large cap growth in the US. I believe Atlassian does not pay a dividend, which is why there's nothing on here. Nope, they don't pay a dividend. Let's go back to the analysis. So this is covered out of our US team, because that's where it trades. So quickly, 24% discount to our fair value. See, 4-star stock, a narrow moat. We did have a question from Jess about narrow versus wide. So when we're talking about sustainable competitive advantages, it doesn't mean it's forever, right? So narrow moats are 10 and less years. We believe it'll last at least 10 years, I guess is a better way of saying it. If it's a wide economic moat, we believe it'll last longer. Right. So very simply, how long can they sustain that competitive advantage? Because remember, people are constantly trying to chip away at that. All right. So Let's read the headline. Atlassian continues to deliver, but cloud investments weigh on margins, lowering fair value to $375. Okay, so we actually cut our fair value relatively recently, August 5th, so last week. What is this actually being? Cloud investments. So they're investing in the cloud. So it is sort of a new product or new way to host their product that Atlassian's doing. And that's weighing on margins, right? More investments by companies weigh on margins. All right. So overall, very quickly, and we don't have that much time left, so I'll go through this quickly. What does Atlassian do? So at the end of the day, Atlassian is like a project management software development software provider. So once again, we're looking at software as a service here. And what it basically means, and we use it here at Morningstar and our teams use it. So as you're going through the software development cycle, you've got a bunch of different people doing stuff. You've got product people creating requirements. You've got developers that are sitting there taking those requirements, understanding them, and then writing code off of them. And then you have to test that code. And Jira manages that whole process. I should have opened up Jira to show you guys, but basically, yeah, we create you develop software in sprints. So you try to do a certain amount of work in a couple of weeks, and Atlassian creates this Jira software that manages that whole process. So that's what Atlassian does. So, they endeavor to unleash the potential of teams. Yeah, I mean, that's nice. But basically, at the end of the day, it's a way for me to get my requirements to someone who's going to build software off of it, and then to get it to a QA person who's going to test it, and then somebody can figure out if they're going to release it. So basically, it's workflow management and software development. It can be used for other things as well. So at the end of the day, so yeah. What do they do? Not going to spend too much time. So here's our original product, Jira, workflow solution for software developers, which is great. And then they're adding on other things. Remember, that's why we like software as a service, potential upsell, right? So you start thinking, okay, what are things you can do? Okay, well, Jira is managing a workflow, but what we're also doing during this whole process is we're collaborating between a product manager, a designer, a developer, a QA folks. We're all collaborating, so they're building software around that to help with that process. Yep. So what are they good at? They've excelled at upselling customers with more seats, additional products, and new use cases. Here's different things you can use Jira. For instance, at Morningstar, we use Jira to approve our marketing communications that have to go through compliance and a couple other checks to get them out there. So we're using Jira in a non-traditional sense. So that's an example of that. All right, let's talk about economic moat. So once again, switching costs. So you're going to see this a lot with software. Once you've got a whole company using Jira, it's very difficult to switch. You would have to train everybody. You'd have to transfer all of these projects that are in flight from Jira to whatever this new workflow management software you do. I can't think of anybody that would want to do that. It would be very, very difficult to do it. I think like with our team, it would be extremely difficult just for our team to do that. Forget like Morningstar as a whole. So switching costs, that is where their economic moat comes from. So, right, the more critical the function and the more touch points across an organization a software vendor has, the higher the switching costs, right? You want to embed your software into as much of what a company does as possible. So yeah, that's important. If you even sit here and look, IT help desk, another thing we use Jira for. My computer breaks. Actually, Shani's computer turned racist a couple of weeks ago and changed the color of the little like hands that wave as part of her, what do we call these? It's not an emoji, a reaction. Part of her reaction in Microsoft Teams, it turned, most people's are yellow, and then Shani's turned to brown. So her computer is actually racist. So I raised a Jira ticket as a joke, which caused some backlash. But yeah, a lot of people do that. If your computer breaks, you raise a Jira ticket, and then that goes to the help desk. They help you. So they're getting themselves into all these different parts of the company. So project planning, really important. Project management, really important. Collaborating with your colleagues, IT help desk, right? So embedding themselves in a company. So it's really, really hard to pull out. And what that means is that allows them also to have pricing power. All right, we'll keep moving quickly since we've got another one to go. So you can read this whole description of why our analyst thinks there's an economic moat. Fair value. Okay, so once again, our fair value estimate is $375 per share, which implies a fiscal 2023 enterprise value sales multiple of 26 times, adjusted price to earnings multiple of 197 times. So even more expensive than Wisetech. So once again, we are looking at a lot of growth. What is the growth? 31% is what they're looking at for total revenue growth. So once again, we're looking at really, really high growth for the company. So think about the risks that may involve of actually achieving that. Then when we start looking at margins, once again, margin expansion. Okay, so driven by scale. So as you start to look at different research reports, you start to study different types of companies, you get to understand, okay, what are we getting out of technology companies? What are we getting out of software as a service? Well, we're getting scale and how important scale is. So if you can grow fast and you have scale, once again, more of that revenue flows down to the bottom line. So that's what we're seeing with margin. Once again, we have market size. So in order to grow really quickly, you need a very big market. And then you have to beat your competitors, right? But the first thing you need is a big market. So 800 million knowledge workers. All right, that's a lot. So they believe the addressable market, the total addressable market is 125 billion. We think it's a little less, but either way, that is a very big market. So there's a big market. Certainly from sort of a knowledge worker perspective, we're seeing a lot of growth. Once again, high uncertainty rating. Why? Company trades at a very high multiple. That's that price to earnings ratio we're talking about. And while it's expected to produce revenue growth at the high end of its peers, and the premium may be justified, right? So he's saying that this price earnings multiple, this very high one, is justified because it's going to grow faster than competitors. If you have high absolute valuation levels, there's less room for missteps, right? This is the problem with price to perfection, right? When companies are priced for perfection and they are not perfect, the share price can fall a lot. And that's sort of the same question that we had about where the market is right now. Are we getting back to a point where even though it may be achievable, this scenario is too rosy, right? That means if anything goes wrong, the market will get slammed, right? Because people's expectations are so high. So if we get a monthly US inflation number next month that is higher than analysts think, the market could get slammed, right? Because we've just decided that inflation's peaked. And maybe it has. And there's a lot of indications that maybe it has, right? Especially with like petrol prices coming down, things like that. So there's a lot of indications that maybe it has, but if it doesn't, and we all expect that it has, then the market could be in a lot of trouble. And that's kind of what we saw going into this year, right? We kept hearing from central banks, we're not raising interest rates, we're not raising interest rates, inflation's fine, it's transitory. Well, it wasn't, right? That's why the market went down so much. Now, going back up, because we think inflation's peaked. Doesn't matter what the absolute level is. Once again, the absolute level is still horrible in the US, but that's sort of the perception. So we'll see what happens. All right, risk and uncertainty. Yep, we're going through this. Very high valuation levels. No real room for errors because of this. Great, you can read through the rest of those. Standard stewardship rating, capital allocation. So yeah, we think they're decent in terms of the way they allocate capital. All right, let's get to our last company, Adobe. So Adobe does all sorts of things, but really they have this thing called a Creative Cloud, which is their software. And basically it's all these different applications that are kind of built into this thing that use for graphic design and video editing and web development and photography and all sorts of stuff like that. And of course, they have the famous Adobe PDF. So yeah, that's what they do. All right, so once again, let's very quickly look at this. You only got 10 minutes left. So I'm actually going to skip down in this case. I'm going to skip down to economic moat. And I think economic moat is an interesting one that we should explore a little bit, because this is the only company of the three that has a wide economic moat. So remember, we think that it has an even more established competitive advantage that will last longer, right? Longer than that 10 years of a narrow moat. All right, so why do we think that? Switching costs and network effects. All right, so looking at the different things that companies does, we believe digital media has a wide moat from switching costs and network effects. Digital experience, another thing that they help out, has a narrow moat, rising from switching costs. Publishing has a narrow moat from switching costs. So basically, we're adding a new one. We are adding this network effect. And the network effect is, of course, when more people use software, it becomes, of course, more valuable, right? And we kind of see this stuff all the time, that, like, you know, if I send somebody something from Adobe and they don't have the software, they can't read it, right? And they can't use it and they can't do anything to it. So of course, that's a simple example of why, if everybody has something, then it's worth more. Now, what happens with moats? Because we talk about moats all the time, and I obviously do this, and I talk about them sort of theoretically, but moats actually show up, and they show up in two different places. And they show up in operating performance on our tab, operating performance. So they show up in margin, and they show up in return on invested capital. So margin, as we've been talking about, refers to how much of what a company produces they actually keep. So that's pretty important. So let's start with margin. We'll get to return on invested capital. There are different margins, right? So gross margin is, we're literally just looking at, you know, sales and the cost to produce that, just like that widget. Operating margin, we're including all the other operating expenses. So not just, you know, a can of Coke and how much it costs to create, but also the employees that are creating that, the rent for the factory where you make that Coke, all those other things. Operating margin. And net margin is finally the bottom, what's on the top end and what's on the bottom end. So how much do you sell versus how much do you keep? These are shockingly high, right? Any way that we look at that. So we look at 2021, these are really, really high numbers, right? And if we sit there, especially, and we compare sort of net margin to the index 18, so yeah, they're making a lot more money. And that's an indication they have a moat. So just like we had Louise say that they raised prices, well, the ability to raise prices indicates that you have a moat, right? You're able to pass on costs to consumers, and you're able to just raise prices higher than your costs grow. And that's how you can expand that margin. So these are really, really shockingly high numbers. And these are numbers that basically you're only going to get in a software company, right? So gross margin, 88%. Like, think about that if you were a car manufacturer and looking at that gross margin. So what does a car sell for? And what is all this stuff that's created in a car? What goes into that? Can you imagine if you made an 88% margin on a car? Like, that's insane. That would never, ever happen. If we look at net margin on like high volume companies like a Kohl's or a Woolies, that net margin would be very low. So that's where we can look at margin or at moat. The other thing is return on invested capital. So what are they earning based on investments that they make in the company to grow? So once again, really, really high, right? So 26%. And remember, we want to look at return on invested capital, and we want to compare that to what it costs to source capital, so our weighted average cost of capital. So if I can go borrow money, I'm Adobe, I can borrow money and invest it and earn, and what they're earning is more than 26, right? So 26, that's a percentage compared to what it would cost to borrow money. Even though borrowing costs have gone up, nobody's paying 26% interest right now to go borrow money. So that difference, that accrues to you as a shareholder. And over time, that compounds and becomes even more and more profound. All right. So running out of time. So Lisa, so Jane first, then we'll get to possibly a stupid question. There are no stupid questions. Since they are cloud-based, would there not be an increased risk of cyber attack problems outside companies' control? Yeah, I mean, absolutely. So, you know, obviously anything on the internet, And more and more, basically almost everything is cloud-based at this point. Yeah, cyber attacks are a huge risk, like across the internet for all companies. So yeah, that is a huge risk, and security is very important. So security both for them, obviously, and everything they're delivering over the cloud, but also security for all of their clients is really important too. That's why people think there's a pretty rosy future for a lot of these internet security companies. Lisa says, do companies such as Google, Atlassian, and Microsoft end up making us all become completely dependent on their successful software continually? What would happen in global business if something happened to corrupt cloud technology? Okay, similar question. Yeah, so when you're asking, Lisa, do companies such as Google, Atlassian, and Microsoft end up making us all completely dependent on their software? That is their plan, right? Like that's what we're talking about, embedding. And we've been talking a lot about companies, but we want to embed technology. If we're a company, embed it within somebody's life so they can't live without it. Why is that important? It means because they're going to keep going back to you as a customer, right? So that's what they're trying to do. And then Lisa, you're asking this other, what would happen in global business? Something happened to corrupt cloud technology. Yeah, it would all shut down, right? Like at the end of the day, like look at, especially around like AWS, and Microsoft has, what do they have? Azure, like especially all this cloud computing stuff, like nobody has servers anymore, right? Like it used to be you'd go in an office and your server that runs all of your computers and all of your software applications, everything else would be sitting in your office. Maybe not like in the office, but it would be sitting within your physical infrastructure. You would own those servers. You don't own them anymore, right? Everyone outsources into the cloud so that you can spin up these new servers really quickly, which is a great thing. But if something happens to that, I would say, Lisa, we are all screwed. Yeah, so Jade, of course, that risk, I mean, what I would consider that risk, talking about the cloud technology, yeah, I mean, I think that risk is just sort of inherent in business, right? So, and I wouldn't call that well, it depends. Like it could be a company specific risk, but yeah, it's a sort of inherent in business. Jesse's saying, is there a section where we can see what Morningstar recommends to buy or sell at the moment? Well, so what I was trying to talk about today is, yeah, it's like we don't have buy and sell recommendations. What we do have, of course, is stocks that we think are cheap, stocks that we think have sustainable competitive advantages. And really what we see this as is a tool you can use to go figure out what is right for you in your personal circumstances. So sort of my screening, or even if you go in to discover investments, what are companies we like? Well, for instance, what are our favorite companies that are in global best ideas? So every month we update global best ideas. Our analysts around the world come up with companies that they believe represent the best opportunity for investors. What your job is as an investor, especially an empowered investor, is to figure out if that's right for you. So once again, we can go through and look at some of the differences of companies that are on here. So, we've got Wisetech, which we talked about, right? Wisetech. We've also got Woodside. So Woodside is a very different company. It is a value company. It is producing oil and gas, very different. Westpac, same thing, very different, large established value company, as opposed to a growth company. Now, in each case, we think that they are relatively cheap, giving them 4-star rating, but you need to figure out as an investor, right, what is right for you? What is right for you based on the goals that you have, and what are you comfortable investing in? I don't particularly love, I don't even say particularly, I don't love these growth companies that are trading for these huge multiples, because that's just not really my personality from an investment standpoint. Doesn't make them good or bad, doesn't mean they're going to do well or not, but I need to be comfortable with how I'm investing because I need to stick with it for the long term. All right, we've somehow made it to 2 o'clock. So Lisa's saying, assuming Adobe doesn't pay dividends, so how does an investor get income? Well, at the end of the day, you sell your shares, right? So, but that's thinking about how important is income to you. I don't invest personally in any shares that don't pay dividends because of my investment strategy and what I'm trying to accomplish. So the way that you would get money out of Adobe is you would sell the shares. You hope they go up in price and sell them. It's not my strategy. That could be yours. But if you're looking for income, then you wouldn't look at any of these shares, even though Wisetech pays a dividend. It's so small that you could make more money in the bank. But anyway, all right. Thank you guys. Sorry, we went over. But if you have any questions, you can email me, mark.lamonica1@morningstar.com. And we'll be back for whatever hard topic Emily has planned for Tuesday. All right. Thank you.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.